Welcome, Henry. I'm excited to have you here. Give a little history, but you and I go way back. Your product is a mainstay for trading firms, for traders, individual investors, I think is really groundbreaking. You were analyzing order flow before people knew what the word order flow meant, except for market makers, adding value to the street and value to brokers. I'm really excited to have you here. Before we begin, I do have to let people know that what you're about to hear is for education purposes only. None of this should be considered investment advice, tax advice, or legal advice of any kind. If you see something and take action, you do so at your own risk. The materials presented as such are meant for education and demonstrative purposes only. All right, Henry.
I agree.
Thank you for being here. I've been excited to speak with you for a while. I'll let you kind of present what you're going to talk about, and then we'll have a little conversation, and then we'll go from there. So welcome.
That sounds
Henry.
Great. Thank you very much. I'm always happy to talk to you and your community. And you're right. I've done nothing but look at options order flow for a good almost 20 years now, and this all came out of the fact that my last trading job was at Bank of America when there were 4 options exchanges, and I was there when the ISE started, and that was the 5th. And seeing how difficult it was becoming to kind of really keep a handle on the order flow, as it was, ISE was purely electronic, and you started to see more of these routed orders. And honestly, I turned to a trader next to me because a sales guy was yelling over. He's like, "Hey, my guy wants to know what's going on in Microsoft." And I was like, "I don't know what's going on in Microsoft options." And the trader next to me said, "Oh, just make something up." And I said, "Okay, it's part of the process." But I said, there's got to be kind of a data-driven way to do this. And so I left B of A with a developer. We started Trade Alert. Really very, very specific function. It was an option order flow analysis system. We went back to all the banks that we'd worked at. All the banks realized this was very helpful when you have, all of a sudden 6, 7, 8, 9, and today 17 options exchanges. And I love looking at order flow, trying to basically find the motivation behind every trade, and that's what I'm going to show you a few things about it. And then I'm happy to talk about as much as you want. Let me see if I can share the whole screen over here. I guess I will go with this one. One thing I wanted to mention, Mark, is what you were showing was actually really interesting. The kind of divergence of sectors this year has been kind of remarkable, and and I can tell because there's stuff that I own which is down 80-90%, and then there's other things that have done really, really well. And I think a lot of people are probably in that boat, going like, "Wow, market's near all-time highs," but I've got a lot of junk that has never really come back from kind of the COVID sell-off, even before that. But what's interesting, kind of very specific to that, and I encourage you and your people to look into, is this CBOE dispersion index. Mandy Zhu has a really nice analysis of basically that index. And I'm not I never traded dispersion. I basically traded index options for the first 5 or 6 years of my trading career, and then single stock for the last 5 or 6. And dispersion trading is a very popular strategy at the big banks and the hedge funds, and it effectively involves selling index volatility and buying single stock volatility. And it works really well, makes a lot of money when you have this wide dispersion. You have some sectors and some stocks that are doing great and some that are getting killed, and not everything moving together. And so the CBOE came out with this dispersion index, and they're going to have listed, believe we're going to have futures on it first, and then options on it. But it basically uses the implied volatility of all the S&P, or nearly all the S&P 500 components to back into the implied dispersion. So basically, you can the easiest way for me to think about it is there are times where stock picking works really, really well, like this year, right? Like exactly what you were just looking at. And then there's times where everything's going down or everything's going up. And okay, in those times where everything is going the same direction, that's very low dispersion, right? And the part of it that made the most sense to me was, you can look at the VIX, right? We look at the VIX all day long. Oh, the VIX is at 12. Oh, the VIX is at 20. What does that tell you? It tells you about expectations for kind of the volatility of the S&P, but it doesn't tell you much more in terms of how the market is expecting things to behave. And so, I've dug into it, and it's an additional dimension to kind of expectations and volatility that we look at all the time. So I love it. That and the VIX 1D I think are really interesting, and they're very new and very kind of relevant metrics to keep an eye on.
Oh,
so
absolutely. I think we're gonna have Neil on in the next couple of sessions to go through dispersion, but we talked about with Gem a little bit, and it is an extremely popular strategy with the funds, but it's also something that retail traders can in fact do if they know how to apply it. So, but that's something we kind of look at in trading desks. We'll trade dispersion. You can even do dispersion between the different ETFs, right? You get like like one of the best dispersion trades that I did in the last couple of, and it was kind of a fake dispersion trade, was the QQQ rebalance. Created a huge dispersion trade between SPY and diamonds because SPY was really overweighted those major sectors, those 7 names that were getting haircut out of the Qs, and the diamonds really weren't. So you could actually go long. So the trade was long diamond, short SPY as a trade, and I guess that's almost a pair trade, but I did with options. But yeah, absolutely. So anyway, I know you've got some great stuff that you want to talk to on order flow, so I'll make myself disappear, and I'll make sure to, if there's relevant questions, we'll take them all at the end. So you just do what you're going to do, and then we'll see where the conversation takes us.
Awesome. Yeah, I will ramble for 25 minutes or so easily, and then interrupt me when it's time to talk about something else. Like I said, I've studied and done nothing but dealt with option data for the last 15 years or so, and to me, we're at all-time record levels of volume, right? This is going to be 11 billion contract year. It's the first time over 11 billion. We're seeing busy days, 50, 60 million contracts. The 2 busiest days ever were the beginning of the year. There were almost 70 million contracts. This is insane, kind of compared to where things were really just 5 or 6 years ago. And this is coming in the form of about 4.5 to 5.5 million individual trades a day. And like I said, when I was a B of A and some customer, through a salesperson is saying, hey, I need color on Microsoft or color on, some symbol, you have a lot of trades to look at to try to figure out what the option market is looking for, what's going on, right? Is volatility higher or lower? Are people buying calls? Are they selling calls, buying puts? You guys are familiar with this. What we did at Trade Alert, literally on kind of day one, was to basically say, okay, let's take every single trade and apply some, to us, it was kind of common sense, but we basically modeled the trade in real time to make our best possible determination of if the initiator was buying or selling the contracts. Okay, every option trade has a buyer and a seller, but there's only one side that decides to make the trade. The liquidity side is reacting. So we basically, these happen to be trades in Bumble today because I noticed this kind of interesting one. But basically on every single trade, and so nowadays it's almost 5 million of them a day, we simply took the time, the bid and offer at the time of the trade, so that we could, and we buffered that in a process, and then we knew when every trade happened if it was trading on the offer or the bid. Okay, real simple side of market rule, but nobody else was doing it at the time, and people were kind of stepping back in their Bloomberg terminal trying to figure out, like, okay, the market was 1 to 105 and it traded at 105, so now I can see it was an offer side trade. And in general, people have to pay the offer to buy things, and they have to hit the bid to sell things. It's not always the case, but usually it is. So at the most simple level, you know that bid side, you can make an educated guess that bid side trades are seller initiated and offer side trades are buyer initiated. Then we kind of took it a little bit further, and yeah, that's what the color coding is on this. Green's an offer side trade, red's a bid side trade. That color coding goes back to when I was on the CBOE floor as a clerk in the late 80s. The screens basically would light up red if you were supposed to sell and green if you were supposed to buy, and everybody used the same color scheme. And nothing's really changed. Well, lots of change, but the colors are the same. So, if you look at just this biggest trade today, the 20,000 lot in Bumble, these are the January 13 puts. Okay, this part is time and sales. You'll see that on anything you look on, any decent platform. But there's additional information. Okay, now this one, in this case, 12 cents is mid-market on a 10-cent bid at 15-cent offer quote. Okay, that's why it's yellow. It's a mid-market trade. You can't quite tell if it's a buyer or seller. But there's another piece of information that we were able to calculate in real time, and now there's actually two. The first is the implied volatility of the trade at the trade time. So this print equates to a 54.1% implied vol. Okay, you can go find a calculator online and back into an implied vol. We just basically have the system doing it in real time. But we also know what yesterday's volatility was. So this is down 2.4 points from yesterday, which actually gives you an indication that, okay, when options are being bought, volatility goes up, and when options are getting sold, volatility goes down. Okay, holding VIX steady, say. In this case, we have a piece of information which tells us, okay, this looks like a seller, even though it's a mid-market trade. The fact is volatility is lower. And then there's one other really important piece of information, which is that the theoretical value at the time of the print was 17 cents. And this is relatively recent for us because we're able to source this from Hanwick, which is a company CBOE bought right before they bought our company. And Hanwick basically does real-time market maker fitted theoretical values, a really sophisticated fitting of interest rates and dividends, smoothing of the inputs to make the values stable, and then they do a nice arbitrage-free curve. It's all the things that Mark and I used to spend our entire life working on, is now basically kind of being done as a service. So now all of a sudden you have some information here, which is they traded 12 cents. It's a mid-market trade, but it's below Theo, and it's a downtick in terms of volatility, and then a few other things that you can infer. In this case, it happened to be a floor trade on the box. There's a condition code for that the exchanges append to the trade. But it also, we actually know that it's an opening trade, and this is not indicated on the trade, but it's inferred because of the fact that there were only two contracts of open interest. And so, and this is where the stock was at the time, 1505. So you now have, you can make a very good guess that this is a put seller, and it's an opening put seller, and it's about $2 below the stock price, and it expires in about a month, a little bit less than a month. So we do this to every single trade in real time, and then we basically set up a tool so that people could get alerts as the trade prints. That helps people that do what I used to do, which is work at a bank when the customers require you to know what's going on. But it also lets us do a couple other cool things, which is aggregate the data and look for deviations from baseline and things like that. And I'll show you a couple other
so let's just walk through this Bumble trade piece by piece so everyone is able to follow along and read. All right, so sure. You've got where it says Bumble, and then it's trading 15.18 up a penny, up 1/10 of a percent. All right, then below that, those arrows are yellow, which means it's mid-market. Those two arrows, and then the amount of contracts that were traded, which is 20,500. Then there's your stock symbol. And then the contract month and year, and then next to that is the expiration date of the contract, the 12th. So these are 20,500, Bumble, January 12th, 2024, and then next to that it says the 13 puts. So that was the strike that they sold, and then you have the price that it traded, and then it says mid again, tells you it went up on the box, and then you have that IV that you talked about and the change in IV. And then what is the below there? It says EMLD 130.
That's the bid offer. So Emerald had the best bid at a dime, and Pearl had the best offer at
So
15.
that is the market, which is another thing you can look at to kind of infer if it's a bid or an offer, right? The mid market was, the mid market there would be 12.5. So then it says floor, so it traded on the floor. So it was, and then it's an opening trade, as you said, because that open interest. And then where the stock, you've got a couple other things, the gamma and the
delta and the gamma.
So everyone can follow along. And the double arrow is the trade itself. And then the color of the arrow is whether it's mid-market, buy, or sell. So you've got yellow for mid-market. You've got that bright green that says they bought it. You've got that bright red that says sell. And now what is this soft pink color?
So that's if it's below the midpoint, but not on the bid. And same thing with the light green. Be above midpoint, but not lifting the offer.
That is probably a sale, but not 100%. But it looks like it's a sale. Great.
Exactly.
Thank you. Sorry, I just want to make sure everyone is following along and able to capture it, because I've seen this a million times, but not everybody has. So there you go.
Yeah. That's really what we try to do is take all the available data and then all the data that we can possibly infer out of the trade and put it all together. And exactly like what you're saying, we try to present it as clearly and simply as possible. But you're right. I've done this for 30 years. So, it's almost natural in terms of like, well, of course, this is the vol. And of course, this is the change. But it's, we want to make it accessible. So, and I'll show off a couple other slick things that were very valuable early on. So in this case here, now you can see this trade happened really early in the morning. It was in the first 8 minutes of the day. This is New York time. If you look at some of these other trades, there's, like I said, there's 17 options exchanges right now. CBOE is one of them. Box is another. And then we actually, like I said, one of the early things that we realized was this market was fragmenting, right? There were new exchanges were popping up. And so we actually realized that putting together trades that had printed across multiple exchanges would be very helpful. So we did what we call the sweep order, and there is a condition code that's included on the exchanges level, but it's not actually always that reliable. And so what we basically did was program the system to monitor every option, every single contract, looking for bursts of activity basically in a quick second. So this 599 lot, for example, which was on that recap, I just zoomed into the details. It actually was made, there was no 599 lot if you look at it in time and sales, the official record, but there were 599 that traded in 0.13 seconds and in the form of 19 pieces that touched 7 exchanges. So these sweep orders that we see a lot of, and we programmed it because we started to see more and more of them. There's a nuance there that is important, which is if you look at the biggest trades in Bumble today, you have this big negotiated trade that happened on the floor, right? And this is the floor works the way the floor has worked for literally almost 50 years, which is there's guys yelling at each other. They say, hey, I want to buy some of these. The market's moving while they're doing this, and they finally agree on a price and they print the trade. This trade might have happened a couple seconds before. It could have even happened 5-10 seconds before, and by the time everybody agrees, this is the information has kind of leaked out. These sweep orders are much more honest, basically, much more reliable. In that somebody lifting the offer, okay, the quote at the time of this 599 lot was 15 cents at 20 cents. Okay, there were 273 showing on the offer. That was on the C2, which is one of the CBOE exchanges. But they managed to trade 599, okay, and they did it in the form of this multi-market sweep I was talking about. So you can actually infer kind of some urgency in that kind of a trade. Now, this is not a huge trade, but these sweep orders have more power to them than the negotiated blocks. And negotiated blocks are big, giant trades, and everybody pays attention to them. But the information is not quite as reliable, and it's not quite as instantaneous as the sweeps. So we found, people kind of eat that up, because there's basically nobody that knows that this was a buyer of 599 contracts except for the customer that put it in and the people that actually are able to see it in our system. I don't think there's anybody else trying to assemble these sweeps. It's not a perfect science. You may theoretically you could miss a couple pieces, or you could include a couple pieces that don't belong to that initial order. But really, the way that things typically trade, like if we look at another one, even this smaller one, 124 contracts, these things are trading so quickly that this is the same customer, and it doesn't, even if there's some slight variation in there, it doesn't really matter. So, in sweeps, we see sweeps making up about 20% of the market, even small ones. And this is what, there's an enormous amount of strikes you can trade, and there's now 6,000 underlyings and 1.5 million strikes, and there's a big business in firms building these smart routers to go sweep the maximum liquidity they can. And the reason for that is because you have 17 exchanges, and let's say there's 100 contracts shown on each exchange. Well, if you want 1,500 contracts, if you go try to buy them all on one, you're going to use up the offer, and on top of that, you're going to scare everybody else off. And in a lot of cases, everybody else is the same couple of liquidity providers. They're just pumping their quotes out to all 17 exchanges, and they invest enormous amounts of resources into making their systems very, very smart, so that if they see a buyer, they're happy to sell some, but they want to get the heck out of the way if it's a big buyer. So, there's companies like Wex and Dash, and these basically B2B routing companies that specialize in building these routers, and they actually advertise that they can get 100% of the shown liquidity, 80% of the time, kind of thing. And it's the way for kind of more urgent trades to be executed. And those trades, and I'm not making recommendations, but when I trade off of order flow, I pay really close attention to the directional sweeps, right? So somebody buying a whole bunch of calls or buying a whole bunch of puts through sweep orders tells you that they're in a hurry to do it, and that they're not negotiating it with a floor broker or a trading desk. They're just buying as much as they can, and the market kind of tends to react to that. So I'll show up one other thing that I think is pretty cool, which is complex order synthesis, basically. So I'm going to show you this one in SPX because it kind of I've been watching this behavior for a few months now. Complex orders are trades involving more than one option, right? You can have a vertical spread, you can have a butterfly, you can have a condor, you can have all sorts of crazy spreads. In general, the most common are vertical spreads, right? I want to buy the Apple 200, 210 call spread because I think the stock is going to go up, right? It's a way if you're buying an option, it's a way to keep the price low because you're only getting exposure for a certain amount. And if you're selling an option, it's a way to cover your butt because you don't have the unlimited loss potential of being short a naked option. And so when we put the system together, we knew that spreads were about a third of the activity. Okay, and when we started, their volume was around 5 or 6 million contracts a day, and basically, again, it's simply kind of common heuristics in terms of when you see a spread trade. You see two legs, basically, let's say a simple spread, and you match them up. You say, okay, well, the timestamps match, the exchanges match, because you can't leg a spread. You can leg a spread, but you can't execute a spread across exchanges. So simply, if you want to look at all the vertical spreads in Apple, these are the spreads that our system caught today. So and we can actually zoom into the detail, which is pretty cool. So like this Apple December 22nd, so these expire on Friday, the 190.95 call spread traded for $3.72. Our system observed that, okay? And here's how we observed it. So you're going to see all the pieces work here. So the timestamp, this happened to print on the ISE, it was exchange number 5, and it was the first electronic exchange. At 9:44:10 with 0.928, okay, this precise millisecond, you had a trade of 200 of these 190 calls and 195 calls. So the milliseconds match, okay, and there is a lot of activity happening out there, but when the milliseconds match, the trades belong together. In addition, you have these complex order book tag, which tells you that it traded in the complex order book. And then we have a little bit more information, and it's just an extension of what I was talking about at the beginning, which is, if something trades on the offer, we're going to assume it's a buyer. If something trades on the bid, it's a safe assumption that it's a seller. It's not perfect, but it works pretty well. In this case, you had the 190s trade on the bid and the 195s trade on the ask. So, and you can see that based on the pricing, right? So these traded at 528, which is below midpoint. Midpoint was 530, and these traded at 156, which is the offer. So now it really looks like this call spread was sold. And then we also have fortunately we have the theoretical value for each leg. So because we've identified this as a vertical spread, we can subtract one price from the other and get a theoretical that matches the timing of these two trades. And so now basically we can say, okay, it looks to me like a seller of the 190.95 call spread, 400 times for $3.72. They got a nice price. Apple is one of the hyper liquid products. Used to be number one. It's been behind Tesla for a while now, but incredibly liquid. You can see actually this one was only a penny wide, 155, 156, and the deeper calls were a dime wide. So matching up these complex order legs has also been kind of a big value add, because nobody else is willing to do it or has the expertise in doing it, because like I said, you got to match up the timestamps, but you also have to write the code so that it knows what trades are common. There's things that people do that, technically nowadays you can have a spread up to 100 legs. And there has been one or two that have printed that way, where somebody's basically executing a big basket of options and they just want a net price. That's just a messy spread. Most of the spreads out there are going to be your typical verticals and calendars and butterflies. And the one I wanted to show you, Mark, I want to know your thoughts on this. If you look at the biggest spread in SPX today, and actually, we've seen this repeat a bunch of times in the last few months. Not the biggest, but this one here, this December 18th. So this was a daily. This was a contract that expired today at 8:35 in the morning. So SPX happens to be open almost. It's open 20 hours a day. It starts trading at 8 at night, goes right up until 9:15, pauses, and then starts again at 9:30. They sold today 47.75.95 call spread for a dime. Okay, this is opening, and it was against a theoretical of 13 cents. We've seen this trade very, very similar in the 3,000 to 5,000 contracts a day range, trade every single day for months now. And it's kind of an interesting, I think it's a really interesting one if you think about the math involved here. So you're talking about a 10-cent spread times 3,500. That's $35,000 they collected. Okay, there's a multiplier in there, right? This is pretty much what they've done every day. They sell a 15 or a 20-point spread for a dime. The risk on that trade, right, is 20 handles times 100 times 3,500. So you're talking about $7 million in risk, and they collected $35,000. And I'm telling you, this $7 million in risk, that's how much margin they had to have in their account for the day. What's kind of wild is I was able to basically roughly pull out all these trades, because they're all very, very similar. They're verticals trading for a dime in the first hour of the day or so, and they're a decent size. This trade is up about $3.1 million on the year. So at first, I was talking to the guys I work with, the people I work with, that's being like, this is the dumbest thing I've ever seen. I can't believe somebody's willing to risk. What's the risk reward there? 7 million divided by
You're
35,000.
getting about what, 0.5% a day.
200 to 1, and I've seen it worse, but because I've actually seen it trade for a nickel. So 200 to 1 risk reward. But I mean, what do you think that's nuts, or is it? I mean, they're up.
It works until it doesn't, right? This, are they literally doing it every day? Or are they staying out of the way of major events?
On Fed days, I've seen them not do it, or I've seen them wait until the afternoon. But it's pretty consistently in the first hour of the day.
I mean, I think it works until it doesn't. Have they had to buy it back yet?
I saw one day I saw it spike up to almost $3, and I was like, "Oh man, now it's where they're gonna puke," and they didn't flinch, and the market sold off a little bit, and they got away with it.
Yeah, I mean, it's gonna work until it doesn't. Like that, the returns on this will normalize. So 50% return year over year is pretty darn good. But a strategy like this will normalize, is what I would say. They will get a comeuppance, maybe $1.5 million, $2 million in a single day. And then the question is, do they come back and sell again? Or do they say, well, that was that? But this feels like a trade that's going to work until it doesn't, and they get a major comeuppance. And do they only sell a call spread?
Yeah.
They only sell the call spread.
They only sell that one side, even though the market's up, and the market is up sharply since they've been doing this, and still no. I ran the data because when I first saw this, I was like, okay, how can I put a bid out there so that I'm on this thing every day? Because I will buy that, because I know, just like you, that eventually they're going to get cleaned out.
Yeah.
And so before I did that, before I tried to do that, I was like, well, let me see how many days we've had a move of, basically they're kind of striking at about 1.3% of the money, right? So so basically any day that we get more than a 1.3, 1.4% move higher, that's going to be the day. And you get about 3 of those days a year, at least going back a few years. It's just a matter of, maybe it's a matter of time, or maybe they've done enough back testing that they're very comfortable with, if I sit out these days, I don't know. I've never seen them adjust the trade. I've never seen them turn it into anything else. But I have seen a few days where they have not traded. Well, I mean, including the Fed.
When they sold this one, let's see, S&P opened pretty much up about 13 points. So at 40, right around 47.33 is where it was trading at the time. They sold it, about $42 out of the money. That's going to be about 1.3%. Now, one of the things is we've been getting a lot of the movement happens overnight, right? And that's the play that they're playing here, is that we're not going to get that movement intraday, and if we can avoid the big intraday ones, then we're going to be fine. Again, I think they will get a comeuppance on this one, but it just depends if they can get a big enough runway.
Yeah, I mean, they're $3 million up now, so I suppose if we blew through both of their strikes one day,
I wonder if they could use some futures hedging on it if they really got stuck. One possibility I'm thinking is, well, maybe they're sitting on a big portfolio. Maybe they're long, hundreds of millions of dollars of S&P, and so basically kind of trimming some delta by doing this is not going to get noticed, because if we do have a 1.5% up day, they're going to make a fortune. I mean, it's still kind of hard to turn that into like why selling something for a dime or a nickel makes sense, because it just doesn't seem like enough. But I think the other thing that this is really makes me think is, the zero DTE obviously has been like, the hottest story of the year. It's really interesting. There's some people that think it's terrible. There's some people that think it's the greatest. Now you've got ETFs using the zero DTE. But the one thing that I think is most interesting about zero DTE is there are so many ways that you can kind of approach it.
And forget about volatility modeling and skew and kurtosis, right? You can just say, listen, how many days have we moved, 1% in, maybe 2 hours, right? Between 11 and 1. And you can backtest. It's not that hard to do.
Yeah.
And then you can basically come up with trades that, whether or not they're guaranteed, I'm sure they're not, but you get people that like it both ways. On this trade specifically, just like, you have the intuition, which is like, this trade is going to kill them eventually, but maybe they'll get away with it for 3 months, 6 months, maybe a year or two. And so it all depends on what your time horizon is.
Right.
It's if you're in this for the long haul, you probably do want to buy that every day. But the problem is you're going to lose your, $35,000 a day. How many days can you do that? So it's really,
it reminds me of, I had a buddy that used to play, roulette.
Roulette. Yeah.
And he would wait until the roulette table had come up, 8 times the same color, and then he'd start betting the other side. And then if he lost, he would double his bet every time until it eventually hit. And what you don't realize is that every single day is its own kind of little binary event. And so, yeah, I mean, this is that strategy. There is a, maybe they do have the real risks associated with it, but it definitely could give them a serious comeuppance. I think it's smart they're not using, they're doing the call side instead of the put side, right?
Mm-hmm.
Although I guess their big risk is, and this is where, and I don't want to dig too deep into SPX, but everybody bets that, you've heard the term gamma bomb and things like that. Everybody bets that it's going to be on a down move.
Yeah, that's where the fear is.
That's where the fear is. What if it's on an up move? That could happen.
Well, yeah.
And CME doesn't have circuit breakers on the upside.
Oh, that's a good point.
So, and everybody's going to be happy, right? There is the complete possibility that all of these calls that are sold for especially with all these funds that are 0 DTE now, right? You have all selling Qs, selling SPX, selling whatever. There is a distinct possibility that we get this big squeeze to the upside, and the market makers will be fine. But if we get a big move to the upside and people like this guy aren't there, one of the values that this guy brings to the table in him selling every day as a market maker, me consistently knowing that I'm going to buy 500, 600 of these call spreads every day, that allows me to sell stuff underneath. Mm-hmm. So when, Henry S decides, hey, I want to buy 1,000. I want to buy 1,000 of the, let's say, 4760 calls. The market makers have the powder, the dry powder to sell it. But now, what if we have a scenario where this guy, we get a big rally, people are a little worried, this guy doesn't come in, and then the funds that do sell have their risk off stuff. They come in to buy, take the whole book, or Goldman sees that we're rallying and takes the whole book. Taking the whole book means everything offered. And now the market makers are sitting there flat, or sitting there high and dry, and their only hedge is in the futures, and things start going parabolic.
Well, I mean, it's. I agree. I mean, it's easy to kind of mentally be like, we crash, right? It's somebody, whatever, shoots the president or something, and market can get a shock, and markets crash every once in a while. But the upside, the truth is the upside is where the infinite risk is. Downside is not actually infinite. We can only go to zero, right? And, you have to keep that in mind when you see some of these stocks get up to like 500, 600 implied vol. and people are like, kind of paying somewhat crazy prices for options. The downside is, yeah, this stock could go to zero, but it can't go below zero. So you
Right.
really do have a defined risk on a naked put, right? The zero strike put is the free one. And so, I'll show you one other shortcut that I made on this little account is inverted skew, right? So, it's usually people pay more for the out of the money puts than they do for the out of the money calls at the same delta, right? And so we use a 25 delta call and put. You can do it in 10% out of the money and some other ways too. But the simplest way is just the 25 delta line 30 days out. And so I actually noticed this one this morning. An inverted skew means that the market's pricing in a bigger chance of an up move than a down move, at least until those pair of options expire, right? A skew translates into a distribution, and a steep skew is a fat downside tail, and an inverted skew, where the call vol is higher than the put, is actually a fat upside tail. And I was kind of, and the market all kind of goes together, right? So, if we have a very scary period where everything gets steep because people are buying puts, they're worried about the world ending or the market crashing, they buy puts and SPY and SPX and everything, right? So everything gets steep at the same time. What this one kind of surprised me in that, if you look at the flattest, and by flattest it's basically anything inverted sorted by the percentile, and this one kind of jumped out at me, that Citibank is inverted out to the 30-day term. You understand it when you're talking about, speculative names and
Chewy and
GameStop.
Baba,
Exactly.
Macy's has a potential buyout.
Yeah, exactly.
Citi had a lot of bull flow today. Actually, all the big banks have been seeing. I don't know if you've been noticing this, but there's been some block out of the money call buyers in the banks.
I did not. I'm restricted on Citi, so I don't pay as much attention to it.
So, for instance, and I'm going to pull this in Citigroup, the biggest trade of the day, and we saw stuff like this in bank last week. Citigroup, 10,000 of the 57.5 calls paid 17 cents, lifting the offer. Went up on the Amex.
Yeah, I see that.
You've got the D's 52 calls for Friday going up, 3,400 of those. So we're seeing Jan 52.5 calls being bought. So we're seeing a lot of baby out of the money call purchases in the big banks. But what's your take on inverted skew? Because that's a good question. My take has always been one of two things. One, there's a lot of speculation on the upside, and things are getting real hot, and that's usually a sign that things are topping out. That's when you start seeing those days where up 10, down 8, up. You see craziness, and things are topping out. Because, and especially in a name like Citi, that tells me that traders are. I always think traders are selling out of their stock and then buying calls to, not be eating crow if the stock keeps going. That's really what creates upside demand for a lot of calls. If you're not when you get that bullish skew set up.
Right. I mean, I remember I worked, the guy that I started Trader with was long a lot of Apple. He loved Apple, and he's done very well in Apple. But every once in a while we'd be looking at it, and he's not a trader, he was a developer. And I was like, the skew in Apple is really flat. Like, you can basically collar the stock, meaning, stock's at 100, you can buy the 90 put and sell the 110 call, and you actually get paid 50 cents or something. I said, you can get free insurance if you're willing to give up with some upside. And here's how I look at inverted skew. It's an incredibly good time if you want to hedge, because it's never gonna, it's the market is telling you there's more of a chance the stock's going to go up than a crash is going to come along. And I don't usually believe it. I would probably stay away from doing that in a meme name. But like even like Citibank, if you're I guess maybe the optimism is the rate cuts are going to help financials.
I think that's a Jan rate cut call.
Gotcha.
That's my guess.
I mean, if you like that, then buy the stock and sell those calls because they are really bid. And the other thing is you also can just buy a call spread, right? Because the one you're buying, you look at where the vol is. At the money vol is probably reasonably fair, just because kind of everything's pretty cheap right now. The one you're buying is reasonable. The one you're selling is basically bid up. You're selling into the demand, and that as a market maker, we like to try to sell into demand. We just also like to try to kind of look out for those pockets where the demand is really, really smart. But most of the time, you want to be a seller. Even GameStop as an example, right? Like we were talking about this on the podcast, right? The open interest at this 127.5 strike January call is huge, and there have been buyers in there paying a dime, okay, basically for kind of nutty amounts of these calls, whether it's one person or hordes of meme stock traders. But when you look at that, like here's just going back, you see these things trading for a dime, trading for 9 cents. I mean, there's a chance this stock explodes. There's a chance anything could happen, right? And but I know a lot of people who are basically trying to figure out ways to be short this, whether they could handle being shorted, naked, or just trying to figure out some way. And in this case, if you looked at the skew, it was so steep up into those out of the money calls that you could buy there were times you could buy the 80 or the 90 strike call for 12 cents and then sell these for 10 cents. Right. And so that's the kind of trade I like to look for in these inverted skew is I don't usually believe that the speculators really know what's going to happen. There's a chance, but you can usually take turn. You can use it to your advantage, I guess is what I'm saying, in the pricing. And if you agree with them, then buy some stock and sell a few of those calls.
Or buy an in the money call spread, right?
Yeah,
because you can create a collar without the stock, and that's the way I would approach that. So yeah, pretty interesting stuff. I love the skew stuff. I love that we've gotten into the zero DTE. So we've got some. We do have a few questions. All right.
Sure.
Well, let's start with this. Do you consider call paper more reliable than put paper because puts are frequently used to hedge stock holdings, or do you think that it really doesn't matter? Calls and puts, they're kind of the same.
I do think call flow is more reliable because exactly what you're asking is puts have two purposes, right? One is you have some information, you believe the stock's going to get creamed, so you go and buy puts. But you also have put buyers who love the stock; they just want some insurance. The year's over in 12 days, and some PM is up. Maybe he's up 40% on the year. Is he going to spend a few percent to lock it in and then go disappear for a few weeks? Yes, he will. Or she will. And we actually ran a strategy, a long short kind of hedge fund for a year. It was back in 2012. And the call side was where we really made our money. And I even spoke to another trader and he said, yeah, we've done that. And basically we buy calls and sell futures as the hedge rather than we were buying stock and shorting stock based on bullish call flow and bearish put flow. And he said that the way he tested it, the performance was just as good with futures. The other issue with that is there are takeovers, right? So even a piece of junk stock can triple on you, especially if it's a drug name or something. And so it's a little safer to kind of focus on the call side.
Yeah. MLV, who was with Sheen and Associates, said his option alert changed the floors big time back in the 2000s. His site killed it. Thank you, my man, MLV from Sheen and Associates. So you got a fan club here.
Very nice.
Yeah, what do you think of? Sometimes we'll see this stuff go above ask or below bid. What do you think of those types of trades, and how does that happen?
I mean, a buyer or seller has the option to tell the exchange to ignore the away markets. In general, there's a rule, right? Best execution requires you can't execute below the bid, even if it's on a different exchange. If somebody says ignore the away markets, they're basically saying, I don't care. I'm going and buying everywhere. In fact, that's really what that intermarket sweep, the ISO flag, is used for. When the exchange gets an order that says ISO, it actually means ignore the away markets. Because the initiator is routing to all the exchanges, and they don't want the exchange to hold up the order and try to go get a fill on a different exchange, which is kind of how things work if there's a better market somewhere else. So I do pay attention to below bid and above offer. I don't actually I don't go crazy about it. Sometimes you just see kind of a big execution. I asked somebody at a bank one time when I was showing a trade that looked really bad, and where they had basically had to pay through the offer for something, and it wasn't a huge trade. I said, why do you think this guy put up with such a terrible fill? And this was at a big bank, and the guy says, oh, we know that customer. He's got a lot more to buy, and he's not concerned about getting best offer on the first 6,000 out of a 50,000 lot. So I don't necessarily, and in that case, there's some information. I actually took that as a really useful piece of information, because I'm like, okay, cool. So when we see a trade through the offer, or a trade with basically a kind of an abnormal amount of edge, right? Like if the other thing that you can use these theos for is like, well, I know that in whatever, XYZ, the average distance from theo for the 30-day options is, a nickel. And then you see a trade happen at 11 cents above the theo. Forget about the bid offer. That actually is a sign that there's more to come in that contract. And so that's actually kind of a useful, subtle piece of information.
That's a really useful piece of information. Yeah, I really find that that we've had some success with stuff that, especially on the call side, when they're going through the offer in a large block, because generally speaking, that stuff doesn't have a bunch of stock with it. The guy has an opinion, and you want to go with it. Now, you mentioned sweeps, and I do think so. Talk to us about the value of sweeps. How do you avoid, a lot of people see these sweep orders and they want to jump on board, and by the time they're buying, they're getting, they're actually selling to the guy who bought.
Yeah.
How do you avoid some of telling the difference between a sweep that is from an institution versus somebody that's on working in an arcade, just buying calls, things like that?
I mean, so you're exactly right in that, some of this fast call sweeping, it moves the stock, right? It moves the stock because maybe the net delta of the trade is big and is not very hedgeable for the liquidity side that gets lifted. But I think that actually even more likely is you start to get people piling in, right? Where if there's somebody tweets, or somebody's on on TV and says, "Hey, we're seeing huge call buying in path." This was one from today. Now this one, the stock ended up at 25.68, and this early call buyer, they paid 30 cents when it was at 24.58. So this was one where it had some real kind of oomph behind it. How to know when it's I don't like to jump into something if the stock's really already moving. There's a kind of a moment where you're like, this looks like something. Does anybody else think this looks like something? You really have to kind of have your own approach to it. I didn't trade this one today, but if I had seen it, I mean, early first couple minutes, also you have to be a little careful. Volatility is still kind of settling in on where it's going to be, and everything else is going on. I do like to sometimes jump into the stock for a quick run. What I usually won't hold it through the end of the day if that's what I'm doing, because in my experience, you get some good same day moves, and in a lot of cases, it doesn't stick. The other thing that I would kind of point out is, like, so in these, the trading community is pretty smart, right? So you had 34,000 of these D27 calls trade today, right? That's pretty huge in this name, which I'd never even heard of before. If you go and you look at the open interest tomorrow,
Yeah.
I'll bet you the open interest goes up by maybe 10,000 contracts.
Yeah.
And that's because some traders are aggressive enough. They're like, hey, listen, if we start buying these and we're aggressive about it, we're going to have our chance to get back out. And basically, if you look at kind of how these traded, they traded, the first buyer paid 30 cents, 33 cents, right? These are all the same things. They're on that first couple minutes. Later in the day, if you look at it, we can chart it on here. So this is the big old burst of activity, and these contracts got up as high as 53 cents here. So from that 30-cent buyer, it wouldn't surprise me. You basically have a little bit of a little bit more action there through the day. We see plenty of that where people overbuy. They basically, they're scalping a dime on maybe 3, 4, 5,000 contracts. And they end up with the position that they wanted on in the first place. So you do want to kind of, and you can, as a retail trader, you can kind of surf that, right? Like, okay, fine. Maybe you ride the stock a little bit. I don't like to go in and pay, the offer for calls that somebody's just been aggressively buying. I'd rather buy the stock, hope the stock moves 10 or 15 cents, and then just get out. So,
well, and a lot of times, if I am going to pay this paper, I'm going to use a different strike, or I'm going to use a different contract, like we used to do as market makers, right? Because a lot of times you'll look and they've run up the 1229s. Market makers will leave the other stuff wrong on purpose. They're like, well, I'll sell 10 too cheap because I'm hoping somebody sells me this stuff. And so they'll leave other things too cheap, and that's a way that you can get around it.
Right.
All right. So that's a really good question. Now, and I do like sweep flow when it gets that big, because it can represent, waiting a day and then getting on board can represent something. But I block flow, I like looking at too, if you've got kind of a longer play, like if you're going to own. Now this you would almost call some of this block play, because they bought, when someone buys 5,000 at once, that's different than buying a few hundred, right? It was in essence kind of a block trade. Now they sold out of some a bit later in the day, but really interesting play. How do large block flow on, let's say, calls or puts, and I won't keep you here much longer because you're just interesting, so that's why we're going long. But large block flow, you've got, how do you separate when there's stock and no stock? And one of the things I like to do, and I don't know if you do this historically, like there was a trader in Lyft that was long the 15 calls in Feb. And over the last couple of days, this trader has got in for 15 cents 2 months, a month ago. They've been systematically selling out of the 15 calls and rolling into the 20-25 call spread and levering the position up a little bit. Are there ways that, one, I know that you can track whether there's stock done with an order, and that is really important in terms of determining whether you want to do a trade or not. Would talk to us a little bit about, maybe differentiating large block flow a little bit.
Yeah, I mean, so the concept of tide, I can see what shows up in this. So, and nothing big tide in Lyft, but there's plenty of big tide trades out in the market, right?
There was a big one, US Steel.
Yeah. Yeah, so 2,200 of these 40 calls versus 220,000 shares of stock. That's a 1-to-1, right?
Yeah.
So we the same way that we match up the legs on a spread, we match up a stock tie. Okay, the timing, there's a difference in timing, and there's a tolerance in delta kind of thing, but we're able to connect those in most cases and get it right. When something prints tied to stock, then that initial delta impact is gone. There isn't any. It doesn't mean that there won't kind of be some residual, but it's much less of a directional trade at that point. It's really just a volatility trade.
Yes.
And maybe they buy this, they tie it to stock specifically to eliminate the delta impact, and then you still see them working out of the stock. Maybe they didn't really want the stock, but they just didn't want to have to pay an extra 15 cents for the option. But it's definitely less meaningful in a directional sense. And then, in terms of tracking rolling, we put in the functionality so that you could, even for these Jan 40 calls, this stock was up on a deal, right? So I'll bet you anything those are closing, and we can actually dig into the Jan 40 calls. We go X Jan 40 call. That we have this life to date flow history.
Oh, that's cool.
So you can actually see, and then what's important is, what did the open interest do the next day?
Right.
So like I said, 2,200 of these tied to stock. They just, that's not an opening trade. That wouldn't really make much sense. And then you can go back in time and say, well, you know what? There are only a couple days where more than a few thousand traded, and the open interest went up. So, back on December 1st, when the stock was only at $36, you can actually just go look at the trades in that contract on that date. And this would be very unfortunate in that it looks like they were selling them for 31 cents, okay, in the complex order book. And then you can go and try to figure out what the complex order was. So, and it's just looking it up backwards, basically. So you can kind of see a bunch of these trading, and it's very similar, right? So this was the 38.40 1x2 call spread trading, and the 40s we can see opened, and you can then go dig into the 38s, and this would be a really bad trade to have on when the stock gets taken out. Mm-hmm. Because this is we saw another ratio in another deal name, in one of the in Hawaiian. I think in Hawaiian Airlines. But this is a trade that ratio call spreads. They only had to pay a quarter for it. They're long from 38 to 40. This is assuming that they were opening.
I remember seeing this thing go up.
Oh, you do?
Yeah.
All right. Well, they got their clock cleaned because they made $2. They made the first 2 points, and then they lost 9 on basically that last the one.
Yep.
So that's a 7-point loser on something.
If they were long the underlying, they're fine, but and they're still probably not super happy.
Yeah.
So that's really cool. And you mentioned someone put something out on Twitter. Like, somebody mentions there's call trading in Twitter. They tweet out, hey, this person's doing, bought 34,000 path calls so far today. Folks, when you see somebody tweet out an order flow comment, there is a 95% chance they are pulling this directly from Trade Alert. They might not be copying the thing, but the guys that are like, oh, look at this order flow, they claim to have some amazing voodoo. This is the source of all that voodoo right here, where you can look at the flow and see what stuff that's trading, and go on and tweet it out. Now, I believe most of those people are supposed to are supposed to credit you guys.
They're supposed to, but
they're supposed to.
They don't.
They don't.
Look at, I know we got to go, but there's that 38.40. So looking at the open interest changes on the 4th so this is Monday from the Friday trading, it actually looks like they were closing out the 38s and opening in the 40s. So then it's a question of,
did they sell out and buy?
it looks like they were covering the 38s because they bought those and selling twice as many of the 40s, which is even worse. I
That
think
is
than the
even
1x2.
worse.
Yeah,
That
that's what
is
it looks like.
that
It's
is that is the trader basically. That's just doubling down on stupid is what that is.
Yeah, that's a rough one.
So we talked about that.
Right.
We talked about last question, because people are like, what could we've gotten a couple comments. Can we just talk? Can you guys just talk all night? No.
No.
One more kind of thought that I have that I wanted to ask your opinion about when it comes to flow. I have found that when I see block trades and they're untied and they're spreads, like a call spread or a put spread, notably call spreads, those seem to be a lot more reliable in the direction of the stock, because typically when someone's doing a spread, they're cost conscious. Why? Because they're betting on the direction. You know, when someone's out buying straight calls, a lot of times maybe they're either selling the stock or they're short and using it as a hedge, things like that. People really aren't. You can't really use a bull debit spread as a good hedge against a short stock position. You can, but you're not
really covering yourself.
You're not getting the margin relief either.
Gotcha.
And so I've noticed that like when I see 5,000 call spreads bought, and then I look, there's no stock, there's nothing with it, and it's opening. Those have been pretty reliable. Do you have any? I mean,
I don't have anything strong on that, but it wouldn't surprise me. I mean, also complex orders are a little bit more sophisticated thinking behind them, right? So like, I mean, if we see sketchy outright directional flow, and some of it's, some of it you can make money on one way or another. But it's, a lot of times it's kind of like a whoosh, whoosh, and it's like they didn't really know anything, and there's just a lot of flow splashing around, and it whips the stock, and you can kind of try to take advantage of that. The complex orders, it is a little bit more sophisticated. I like what you're saying in terms of it's less likely to be a hedge. It's more likely to be kind of and the other thing is with a complex order, or with this, a vertical spread, because you're reducing the premium, you can kind of size it up, or they can kind of size it up. So I'll have to look around for kind of some good examples, especially I'm trying to do a year end kind of some of the biggest moves we've seen that had unusual option flow in the week prior. It's a tricky query
I can give you a few.
Okay, I'll take your suggestions, and so I think it makes a lot of sense. It's I don't know, there was an example of a there are trades occasionally that somebody had inside information, and there was a period in like 2009 and 2010 where there were a bunch of them in the options world, and that ties to when some of the court cases against Galleon and stuff were going around. But I don't know, you see it, and there was an example in a takeover name where they were very sophisticated. They actually sold a calendar spread, and because it was a cash deal, the long dated call went to zero and the short dated call spiked on them. So it was a diagonal. And that would be a hard one for regulation to kind of notice, because it's not, if somebody buys an outright 800 lot of calls in an account that's just been recently opened, it's pretty obvious, right? They get in trouble. Somebody says, no, I sold a spread, or I bought a spread, and maybe they'll be like, all right, yeah, I guess you're right. He bought 800 calls, but he sold 800 other calls, and maybe they get away with it.
I mean, my best outright trade of the year was off a call spread in GM. They bought the 33 on that big pop they had when it was in the toilet. I gotta double check the date. When was what that day they had that big gap? That was the 28th. I think you and I were talking about this on the phone when I was asking you to do this. On November 28th, I'll get the time and sales up.
All right. I'll find the jump. Hold on a second.
It might have been the 27th, but right there. No, you see, this is, look, check this out. On November 28th, they bought the 29-32 call 1x2 call 1x2 front spread. They paid 64 cents, sold 8. I don't know why they even sold the 8 other than just to further shove it in their faces. And it was expiring on December 15th. And the next day, the stock, they unwound it. The stock went right. The stock peaked at like $32. And yeah, I mean, $32. It went right there. But they were quite pleased with themselves the next day.
Yeah, that's a good one. That's a really good one.
So, spread, but that's part of the reason why I think we're seeing spreads. It's also an easier way to show I'm not cheating, right? If I was cheating, I would have just bought calls. Although I've always said to people, if you're gonna cheat, sell puts. Then nobody's mad.
This is true. You're right. But that 1x2 opened.
Yeah. Oh yeah.
Both sides opened.
Yep.
Yeah. Good one. Okay. All right, Mark. It's been fun.
Yeah.
Everybody.
So Henry, you're here. We've got people asking, hey, I want Trade Alert, or I want to be able to use this. How can people join?
If you go to cbo.com/RMA, which stands for Risk and Market Analytics, that's where we have all four of our platforms. LiveVol is one, right? That you use. Trade Alert, Silex, and FT Options. There is at the bottom of that, there is a place to send us a message, and you can say, I watched Mark Sebastian's webinar and I'd like a trial. You don't even have to sign up. Just ask for a trial, and we will set people up with. I think it's a 2-week trial right now, and you can see all the good stuff.
Yeah, and I still want you and I have talked back and forth about some specific flow analytics, but I gotta react. I gotta get moving on this thing, because
let's make 2024 the year of a nice option pit tool.
Yes, and folks, if you don't have Delta Strike, which is the service that I use for all this big money flow, why not? I would say, we are kind of the same thing. Oh, we're sorry you missed most of it as well, Tamara. We're going to be putting out a replay, but when we put out the replay, we'll put an offer in to Delta Strike for you to join at a really great price if you haven't. Henry, we're going to put this up on our YouTube channel. I'll get the replay to this, because I think we had a good conversation. I think we went across a lot of interesting topics, and people are going to want to see this.
Cool. All right, great.
So I'll put that. We're going to put this on YouTube. We'll tweet it out, and I'll make sure you know where to find it.
All right.
But
awesome. Thanks,
if you are not a member of Delta Strike, like I said, check the replay. We'll put a link in chat, or call my team 888-872-3301. Henry, I posted the link for people to sign up. Say that you were here at the Option Pit presentation, and they'll give you a 2-week free trial.
Yep.
Can't do better than that. All right, everybody. I want to say thank you. So for the Flow Master, Henry Schwartz, I am Mark Sebastian, your only option, and I hope you have a great day.
All right. Bye, Mark.